Just because something has fallen a lot in price does not make it a good deal. Whenever I hear people say buy the dip, it makes me cringe. You hear it all the time. So I'm here to teach you in this video what that really means. Let me give you a hypothetical. Let's say somebody offered a house in your neighborhood for $10 million. That house was 500 square feet. Sound ridiculous, right? Good news. They lowered the price 30%. It's only $7 million now. Think about it, guys. Home prices are going up. They just dropped their price by 30% to $7 million. Great deal, right? That's my point. Now, you might sit there and say it's extreme. It's really not extreme. It's what I see every single day happening in stocks. That people see a drop of 5% and think buy the dip. As of this very second, the NASDAQ is currently down almost 5% on the day, 4.7%. Does that really mean that stocks are a good deal? No. Does it mean they're a better deal than they were yesterday? Absolutely. But it doesn't make them a good deal. ARK Investments has gone from $160 a share down to $36 to $35 a share. Does that make it a good deal? When I look at ARK's portfolio, I do not think it's a good deal. Guys, you need to look at all investments and understand the fundamentals. When you understand the fundamentals, you will be able to determine what is a good deal and what is not a good deal. Something falling in half, something falling by 80% might not be a great deal. Palantir and Peloton are down 80, 90%. I still don't own them. Why? I look at them and say, I can't really determine how much they're going to make in the future. So for that reason, I'm out. Could they be a good deal at 7, 8, 9, 10 bucks? Sure. But if you don't have a process for understanding how to value the business, you're just making decisions based on the actual price of the stock. And they can be manipulated very, very easily by issuing or taking back shares. Don't fall for that trap. But guess what? Your Uncle Paul, I used to be in that same boat. I used to look at things that same way. Oh, this thing is a discount because it used to be selling for this. Guess how I learned? The hard way. I'd buy a stock that was down a lot. And I'd sit there and say, well, it's down a lot, so it must be good. I had half the equation right. The other half of the equation, unfortunately, is 90% of the results. What's the company actually worth? Now, the great news is, on this channel, if you're new to this channel, we have 1,600 or more videos where we analyze companies and we use our stock analyzer tool to determine a value for the company. Let me show it to you now. So you go here, you pick up a company, Microsoft. Now, guys, look at Microsoft. This is a company that was trading as high as $349, $350 in last year. It is currently sitting at $242 a share. A lot of people would argue that's a 30% drop in price. That's a good deal. Let's go to the stock analyzer tool and determine it. So the stock analyzer tool, what it does is every investment is the present value of all future cash flow. So the stock analyzer tool allows you to make your assumptions because the future is unknown. So when Warren Buffett and Charlie Munger talk about the future, they say, listen, we don't know the future. We want to make conservative assumptions and buy companies at reasonable prices based on those assumptions. So I do a 10-year outlook. Now, revenue growth is the very first attribute. I'm going to put in 6, 8, and 10% revenue growth. Profit margin. Here are their 1, 5, and 10-year numbers. I made my assumptions on the revenue growth lower than the last 10 years. But remember, the company's larger and larger, so the revenue growth on the low side should still be a lot lower. It's harder to double revenue when you've already gone up, when you're at $100 billion in revenue, $150 billion in revenue. So you have to be more conservative. Profit margin. I'm going to be more aggressive on profit margin. I'm going to do 31, 34, and 37%. Free cash flow, 31, 32, and 33%. PE. Now, guys, over long periods of time, PE on companies as they get bigger and have lower growth should decrease. So I'm going to call this 14, 16, and 18 times. Same with price to free cash flow. And for my desired return, I want 12.5% because I want to buy this company as a value deal. Hit the analyze button and look, it still doesn't hit my numbers. So even with Microsoft being down 30% or more, I'm still not in the green on any of these numbers. Let me go change some assumptions above. Let me call it 10% return. I just want to buy Microsoft what I think the market will do or should do. Analyze. Only one of the 6 numbers now says to buy. Guys, this is the point. This company is down 30% and it's still not a buy, according to this. Let's pick another company out. Let's pick out Hewlett-Packard. Everybody likes Hewlett-Packard because Warren Buffett and crew own it. So let's go with Hewlett-Packard, a very boring company not growing. So Hewlett-Packard, let's see their historical. They hit a high of 41 and they're currently at $33. So they're down. Stock analyzer tool. Revenue growth. Last 5 years, 4.5%. They still have some divisions and that's why there's a negative growth on 10 years. I'm going to go conservative. 0, 2, and 4% revenue growth. Profit margin, 7, 8, and 9%. Free cash flow, 7, 8, and 9. PE, 12, 14, 16. I'm even going lower PE than Microsoft. Why? They're a boring company without much growth. And I'm going to go 12.5%. Analyze, all green. Guess what, guys? It was going to be, when it hit its high of 41 the last year, it was all green, even on the top 2. What's my point here? Overvalued companies can drop and still not be worth it. Undervalued companies can be dropped and be even more worth it if you like this. That is the point of a process. If you like HPQ, I guarantee you, if Warren Buffett likes HPQ, he's buying more of it today. Why? Because he liked it at 38, 39. He's going to love it at 33. He's going to love it even more at 25. Unless something fundamentally changes in the business that makes these assumptions wrong, you stick with it. And when the markets are all going down, I look at this as a buying opportunity. So if you believe in Hewlett Packard based on these assumptions, you have nothing to do but buy. On Microsoft, you have to wait, even if the stock is down 30%. Because look at the companies in the dot-com crash. Look at all the banks in 2008, 2009. Look at every bubble in history. Something falling by 80, 90% sometimes didn't stop it from going to zero. And that's the key. Understand that you're buying a business. You're buying a future stream of cash flow. If you understand that, when something falls in price and you're able to determine the value, if the price is still too high, you just wait a little bit longer. Eventually, the fundamentals get better or the price will get lower or some combination of both, and you'll be able to buy the company because no company stays overpriced forever. It has never happened and never will. Thanks very much, guys. Please watch the next video.